As you say, there are many types of infrastructure funds around, but they tend to invest in a particular region or a particular asset class. So, for example, in the UK or elsewhere, or in, for example, renewable energy, this invests in a diverse range of underlying investments in quoted stocks. The Premier Global Infrastructure Trust invests across geographies and across regions and across asset classes. This provides a good, balanced, diversified fund that invests, for example, not only in developed markets but also emerging economies. The company invests in a whole wide range of assets, including water, gas, electricity, but also in transportation, including airports and roads and toll roads. The management team of James Smith and Claire Long have run the trust since 2012 and have a long track record investing in infrastructure. The fund is a closed investment trust with two types of shares: the ZDPs, the zero-dividend preference shares, and the ordinary shares. The ZDPs have first call on capital, and they are scheduled to mature in November 2020. The ordinary shares own the capital up over and above the ZDPs, hence the geared exposure to the underlying portfolio. The ordinary shares receive all the generated income, which currently produces some 8% to the shareholders. The directors of the trust will be looking to refinance the ZDPs next year, 2020, according to obviously the shareholder wishes, and obviously looking for the continuation of the trust.
The Premier Global Infrastructure Trust aims to pay a high, regular and rising dividend, together with the potential for longer-term capital growth. So it's really suited to investors specifically seeking income. Because of the Trust's capital structure, whereby the costs of the zero-dividend preference shares are taken through capital rather than income, this means the ordinary shareholders enjoy the dividends they received on the full portfolio, and the Trust is therefore able to pay an enhanced dividend over and above what would be available on an ungeared portfolio. This structure results in a higher level of gearing, by which we mean that underlying movements in the portfolio and dividends received on the portfolio are magnified in the hands of ordinary shareholders. Therefore, the Trust really is suitable for those shareholders looking to take a longer-term view and willing to accept the potential for higher volatility in return for potentially higher income. The Trust is also suitable for those investors looking for a globally diverse exposure to utilities, infrastructure and renewable energy, and are willing to invest a portion of their capital in emerging markets, particularly those of China, Asia and Latin America.
Well, there are three main themes or strands to the portfolio: yield equities, growth equities, and yieldcos and investment funds. Taking each of these in turn, just to put a little bit more detail there, yield equities are those incumbent, larger, more mature businesses operating established assets, able to pay a high level of dividend with a degree, but a limited degree of dividend growth over time. Growth assets, on the other hand, tend to be smaller companies, often in emerging markets, perhaps at an earlier stage in their development. Dividends will be lower, but the rate of growth of those dividends, importantly, will be higher. So an example of the first, the yield equity might be National Grid, for example, and a growth equity is China Everbright International, Chinese waste energy company. The third group, yieldcos, these are yield companies set up to pay a high level of dividends from a set of operating assets. Although the growth of those dividends may be limited, the rate that they'll be set at will be high, and they're typically renewable energy companies, for example.
The parts of the portfolio that have performed best over recent years is mainly the US utility, infrastructure and renewable energy companies. And they've benefited from two positive effects. Firstly, a declining interest rate environment, which has had a positive valuation benefit. And secondly, a general flight to quality away from cyclicals toward defensives and away from emerging toward developed markets. The parts of the portfolio that have performed worst would mainly be emerging markets, but in particular in China. As we all know, China and the US have been engaged in an increasingly complex trade war over recent years, and that's had a very damaging effect on sentiment toward Chinese stocks. With that in mind, though, I should point out that we do invest in mainly the domestic market, mainly in environmental companies such as waste to energy, gas distribution, or renewable energy. And these are companies that are not exposed directly to a trade war with the United States. However, as a result of the declining share prices, together with earnings that have continued to grow and dividends that have continued to grow, many of those Chinese investments are now trading at compelling valuation levels. Lastly, I just mentioned the UK, where we've had a continued risk of nationalisation over recent years, which we feel has presented a good opportunity in UK regulated assets.
First and foremost, we're looking for a high level of sustainable cash flows and low demand risk. This leads us towards asset-backed companies with assets that are regulated and remunerated based on an agreed level of capital, or on the other hand, companies with long-term contracts such as toll roads or waste-to-energy companies, often with a degree of inflation linkage, or fixed price contracts such as renewable energy companies. We're also looking for assets that give us exposure to areas of structural change. So again, companies invested in waste to energy, waste incineration as an alternative to landfill, and another obvious example being renewable energy companies taking over increasingly from fossil fuels such as coal and gas. We're also looking for companies that are under the radar for most investors. These may often be smaller companies which present attractive opportunities. And finally, we are of course valuation driven as a key means of producing a sustainable yield for the trust.